Hi there, this is Ken Fear with SFG Financial Solutions, and in today's video, I'm going to go over the infinite banking concept, or IBC for short, and I'm also going to go over our proprietary software called Debt-Free Life. This is a great software system that allows people to use the infinite banking model to really eliminate all of their debt in a fraction of the time, saving typically thousands of dollars in interest and a lot of time off their debt. So I have a question for everybody to start with is, if every dollar you made was suddenly worth two and all of your debts were paid off, would your life be more comfortable? Obviously, for most people, the answer is going to be yes. Well, that's really what you can do with infinite banking. So who uses infinite banking? So this is a concept that's been around for a long, long time. So first of all, John D. Rockefeller, from Standard Oil Company, big, oil tycoon of our country, over 100 years ago, really utilized the infinite banking concept, and his family today are multi-billionaires that still use this concept. We also have Walt Disney. So Disney actually tried to get traditional financing to fund Disneyland and Disney World, and was turned down by most banks. So we actually used infinite banking concept to actually fund that business. We also got Ray Kroc, the founder of McDonald's, same thing. Was looking to franchise the business model, and really, again, was having a hard time getting banks to approve them. So he used the infinite banking concept to fund McDonald's. So those are a couple, big businesses, obviously, that have generated a lot of money over many, many decades. So let's talk about today. So today we've got, celebrities and, sports gurus, stuff like that. We got, Irvin Magic Johnson there, basketball legend. He uses infinite banking. The majority of U.S. Congress really uses this model. And also Warren Buffett, arguably one of the best investment minds of our time, and the owner of Berkshire Hathaway. So again, this has been utilized for well over 100 years, but people are still using it today more than ever. Okay, so first of all, let's talk about who infinite banking is really for, right? Who's the ideal person? So it's for people that feel like their debt is preventing them from saving for retirement. It's also for people that do not want to have a mortgage during retirement years. It's also for people who want to become their own bank. It's also for people that want to pay off their mortgage without refinancing or increasing their monthly payments. It's great for real estate investors, and it's also great for small business owners or self-employed. Okay. So, really, what is it, right? So it's really like a savings account on steroids. Okay. So here's some of the key bullet points of an infinite banking model, right? So first of all, high interest payments. It's got guaranteed growth. You use every dollar twice. You have access to cash without penalty anytime, unlike, traditional retirement accounts, 401ks, IRAs. So, there's some limitations there, usually by age. Generate additional income for you the way we've designed them. Greater control of your money, provides tax-free income, which is great for tax-free retirement income. Shelters your assets and protects them. That's why a lot of small business owners and real estate investors utilize this concept. And it really creates generational wealth, just like I mentioned there, the Rockefellers who have done that for, multiple generations now. So just to explain what it is, it's a participating whole life insurance contract. Okay, so it's not your parents' or grandparents' whole life insurance policy. So it's very different the way it's designed. So that's really what it comes down to, is the way it's designed, what companies you use, and how it's funded. Okay, it uses laws and the 7702 U.S. tax code to create a protected and guaranteed financial vehicle inside the life insurance policy. While it does have a death benefit like traditional insurance, it's structured to minimize the death benefit and maximize the cash accumulation within the program. All right, so let's look at some numbers here. So, let's talk about just the interest rate. So, again, key number one was benefit of the higher interest rates, right? So typical, if you just Google and look at, what's the average savings account interest rate, it comes up with 0.42%. You hear it all the time, less than 1%. Sometimes in some, there's some high yield savings accounts in a high interest rate environment like we are today when this is being recorded. But typically most savings account pay out less than 1%, right? Which doesn't even keep up with inflation, unfortunately, right? So infinite banking over the last 3 years has been 5.8% based on the company and the carrier that we use most of the time. But a big difference between these two here is if you notice at the bottom there, well, any interest that you get in a savings account or most other investments, it's taxable, right? So you're going to get a tax, you're going to get a form that you have to, submit that to your taxes for that year and pay the taxes on that gain from your savings account. So not only are they not paying you much, then they're going to take, whatever your tax bracket, 25, 35% of it, right? Well, an infinite bank there, it's non-taxable. So again, that's worth, really like an additional 25 to 30% if you look at it. So let's look at the track record. So this is that same company. Like I said, there's numerous insurance carriers that we utilize. We're actually contracted with over 40, 50 different companies, and some of them really specialize in this. And one of them that we utilize most often, this is the track record of their payout. So they have a guaranteed interest rate, a certain percentage that's guaranteed no matter what, and then they pay a dividend out on top of that. That dividend's been paid out every single year for over 100 years. So it's, pretty consistent, right? So if you look at this track record here, you can see since 2004 through 2022, 5.8%. The lowest we've seen in this almost 20-year record here, track record, is about 5.6%. So you can see it's right in that, 6.5% most of the time. But we're going to use 5.8% because that's what's going on in the last 3 years. So we'll use that for our illustration here today. All right, so what's in a participating whole life insurance policy, what's great about it is when you fund it, your contribution goes down. So the more money over time, you can put in less money, but the cash value and death benefit continually increase over time. Okay, and I'll show you how that works. So let's talk about how you use every dollar twice. Like, what does that really mean, right? Well, let's look at how a typical bank works, right? So imagine you had $10,000 sitting in your savings account, and you wanted to purchase, say, a car, or you needed that money for some reason, right? Well, you take out $9,000 and you have $1,000 left, right? So that money is now gone. Okay. So with an infinite bank, right? So you have that $10,000 built up into your infinite bank, your own private bank. You need to utilize $9,000 for, again, purchasing a car or emergency or whatever you need that money for. There's no questions. There's no qualification. You can access that money anytime. Well, basically, you're going to borrow against the life insurance policy. So basically, you take out the $9,000. The insurance company is going to give you that $9,000. So you still have $10,000 gaining at that 5.8 to 6.5% interest. And even though you're using your $9,000 somewhere else, right? So that's the concept of using your dollar twice. So what it's called is the term for it is called a non-direct loan recognition. So this allows policyholders to take loans against their life insurance policy's cash value without impacting the growth rate of the cash value, as the interest credit to the cash value remains unchanged by the loan. So again, your $10,000 still gaining, say, 5.8%, but you're using your $9,000 somewhere else, again, to purchase something or emergency. It doesn't matter what it is, but you're still using it. So technically, you're using your dollar twice. Okay. So life insurance is the only financial vehicle that allows you to earn compound interest on the entire balance, just like in this example I just shared, even when you're using the money outside the policy. Okay. So it's better than a loan because it's already your money, right? And it's better than a savings account because it earned interest on the entire principal, even when you're using the money somewhere else. Okay, so how do banks make money? So let's do a little comparison here, right? So you can, again, a lot of people hold a lot of money in the bank, right? Which is typically one of the worst places to hold money. So because, again, low interest rates, right? So you put $1,000 into a savings account, right? So what do they do with that money, right? So they give you, say, 1%. So on the high side, just to make it simple for math purposes. So on that $1,000 you put in your savings account, the bank's going to pay you $10, okay? Well, what they're going to do with it, they're going to loan it out for mortgages, okay? Auto loans, business loans, personal loans, credit cards, mortgage, okay? Credit cards. Okay, so that same thing, they actually use, they spread that out over 7 different types of loans to people like you and I, right? So the bank profits about $705 on average, okay, using those interest rates for each of those type of loans, right? They average $705 on that $1,000 of our money, okay, your money, and they're only going to pay us $10 of it, so they're netting $695. Okay, so that's your traditional bank. So how insurance companies make money, a little bit different, right? So policies go into your policy premium goes to the insurance company, and they have a contract, right, for that money that's being held there. Premiums kept in the general account to invest. Okay, so what do the insurance companies invest in? So they loan money to third-party lenders, right? Credit card companies, banks, auto companies, mortgage companies. So they lend that money out to them, okay? And then policy owners are given priority to borrow at a fixed rate, which I'll explain that in our example here ahead. But that's just a simple explanation of how insurance companies make money. Okay, so let's talk about some tax laws, right? So tax-free income. So as I mentioned earlier, there's a tax code called 7702. This allows you to overfund a life insurance policy and pull the money back out tax-free. Okay, so loans are not taxed here in the United States, right? So that's why when your money's sitting there, that $10,000, and again, as an example, well, you're going to borrow $9,000 against the value of your policy. Look at $10,000 as your credit limit with the insurance company, but you don't have to qualify. You have access to it anytime. So that $9,000 comes in the form of a loan from the insurance company. Okay, so the death benefit of the life insurance policy is also non-tax. So even though you might have $10,000 cash value, you might have a couple $100,000 in life insurance value. So that's that safety net for your family and your beneficiaries that, okay, hey, they get that, if something happens to you. Okay, in order to stay tax-free, an infinite bank must be properly structured by a qualified licensed professional, so that the cash value of the program never exceeds the death benefit. So there's a way that these have to be designed properly, and again with the right carriers, so that they never can be taxed, right, is really the whole structure behind it. Okay, so the 7702 tax code allows you to put a boatload of money inside a life insurance policy and pull the money out tax-free. So how that works is the premium payment goes into the participating whole life policy. And then you can take that money as far as a death benefit, as I mentioned, tax-free if you pass away at some point, or tax-free compound interest in the account, right? So gaining that 5.8, 6.5, range there, compound interest every single year, tax-free. And then say you want to use it for any purpose, again, because you're taking in the form of a loan, it basically comes out, tax-free, penalty-free, which is great. Again, comparing this to an IRA, 401k, some other type of investment accounts, it's very limited in when you can access the money. What's great about most of these policies, you can access 90% of the cash value within about 30 days of the policy being enforced, right? So pretty much immediately. Okay, so this is also a great shelter for your assets, okay? So look at it as like a Swiss bank account, right? But lives locally, okay? Profits and gains inside the infinite bank cannot be seen or taxed by the IRS. So you never have to pay taxes on that money, okay? And if you are ever sued, funds in the infinite bank are safeguarded and inaccessible to plaintiffs. So again, that's why a lot of small business owners, real estate investors, the US government, right? A lot of high profile, high net worth people put a lot of money into these type of policies because again, God forbid someone gets sued or whatever it may be, well, they can't access this money, which is a good protection, right? So, what do you think that all these banks have in common, right? So these are some of the top name banks out there. Well, they all use life insurance as an asset. So a lot of people look at life insurance as just a cost, right? You buy term life insurance as that safety net, God forbid something happens to you, right? So this is really more of an asset. So a lot of, these banks put a lot of money into these type of insurance policies. And it's called BOLI, which stands for bank-owned life insurance, okay? So this is a list that just came out about a year or two ago of some of the top banks out there and how much money they have currently in life insurance. They take a good portion of their tier one assets and put it into this type of vehicle, again, for all the benefits I've already discussed, right? Tax benefits, guaranteed interest, safety, all that. So Bank of America, $24 billion. Wells Fargo, $19 billion. Chase, $12 billion. The top of the list, there are some of the top three common banks right there. So again, we're just helping normal families like you and I utilize this concept. You don't have to be a big bank or a big corporation to do that. So what do you think all these companies have in common? Well, same thing. they all use life insurance to put some of their assets in. Okay, so again, this is what we teach our clients to utilize that concept. So how you can make money, right? So say we've got your policy and you've built up about $20,000. There's different ways to fund these policies, which I'll talk about, but say it's built up to about $20,000 in cash value. Okay. Well, say you borrow $6,000 for whatever purpose. They're going to charge you a 5% simple interest to borrow that money from the insurance company. They're required to charge you an interest rate, and we're just going to say it's 5%. Typically, it's around 4.5%, 5% for most of the companies we use. Okay, the interest you owe would be $300. Okay, so your policy now has a death benefit of $500,000 in this example. The cash value is like your credit limit, right? You earn, again, using that 5.8% or maybe more, right? Or maybe a little bit less, but that's good average, 5 to 6% compound interest on all $20,000, even though you're using $6,000 somewhere else. So what does this look like in math? So you use that $6,000 for some other purpose, right? Pay off debt, purchase something, whether it's equipment for your business or it's payroll for your business or it's a car for yourself, whatever it may be. Well, in this example here, you've got $1,160 that you earned at 5.8% on the full $20,000, but you owe the bank that year the insurance company that year $300 of the $6,000 that you borrowed. So you're actually netting $860, right? So you're actually making money. Okay, it's called arbitrage. So you're making the difference from what the insurance companies charge you to what you're earning on the policy, right? So let's do a real life example. Okay, so we're going to go through, say you want to purchase a car, right? So there's usually three different ways to really, in most common ways to purchase a car, right? So say you wanted to purchase a $20,000 car. Well, you can go get a loan from the bank, right? So I'd say at 48, months, 12% interest, your payment's about $526 a month. Okay, so you pay $5,280 in interest to purchase that car. So that car technically costs you $25,280. Okay, so you no longer have access to the the $20,000 because you have that loan. You paid $5,280 in interest. Okay, and you own the car. So that's what happens after 4 years. Okay, that's a typo. It should say 20,000. Okay, because that's what the bank loan is. Okay, so in this next scenario, you pay $20,000 cash for the car. Okay, so over time, you no longer have the $20,000 in your savings account to access, right? You paid zero interest and you own the car. So that's option 2. Now we're going to go to option 3. Let's utilize the cash value of your life insurance policy, your infinite bank, to purchase the car. Okay, so you have that $20,000 that you borrow from your policy. I'm going to use that same 48 months. You're going to pay it back at 48 months at 5% interest, not 12%, because that's what the insurance company. So that's one big benefit here, is much lower interest rates. So your monthly payment's now $460. So it's over $100 less per month just in your monthly payment, which is nice. You're only paying $2,108 in interest, but you earned $5,059 on that $20,000 over those 4 years with your money in the policy. Okay, so over time, you still have access on your credit to $20,000 if you need it for something else. You profit $2,951 and you own the car. So you actually made money by borrowing money against your own infinite bank, right? So, and another key thing I want to take note of, which is very important in this simple scenario of purchasing a $20,000 car, is you can pay it back at your own pace. So, say something happens, say you lose a job, or, money gets tight, whatever it is. Well, it's hard to call the bank and say, hey, I want to skip my car payment for the next, 3 months, 6 months, 9 months, right? They're going to say, sorry, you have to make your payment, right? Or maybe refinance, right? Or something along those lines, and go through that and pay them more in the long run. Well, here, you can pay it back at your own pace. You can pay it back faster than 48 months, no problem. You can pay it back longer than 48 months. You have the option to lower your payment to as low as $50. So think about that, because a lot of people run into emergencies and hard times. So that's a big deal. And we're just looking at $20,000. What if you borrowed $200,000 for an investment property? Because again, a lot of real estate investors use this. You know what I mean? So again, you really have such flexibility with your money utilizing this concept. Okay. So infinite banking is basically we're bypassing the banks and paying yourself, as you just saw in that last example, how you're earning money by utilizing your own bank to pay off debt in that example. Okay, so let's talk a little bit about our proprietary software called Debt Free Life. Okay, so what does this look like in practicality? Well, this is proprietary software, so it's really cool. Is you send us over your mortgage, your credit card, school loans, auto loans, whatever it may be, or if you're a company, you send over your business. Say you're a small business owner, you send over all of your debts. We do that for small business owners all the time. You send that over to us, and we plug this into our software. The software is going to compute the fastest way to pay it off, okay? And it's going to use your overpayments. So if you're paying a little bit over on each credit card, maybe $50 or $100 here and there, or you're paying $100 or $200 extra on your mortgage. So it's going to use that extra money to build your infinite bank and pay things off much faster. Again, saving a lot of money and interest in a lot of years. And I'm going to show you this in a real life example. Okay. So this couple here in Tennessee, right? So they have consumer debt of $106,000. That would be basically credit cards, car payments, student loans, stuff like that. So the average interest rate, it figured it out. Our software shows exactly what it is. Whoops. And it's about 33% interest that they'd pay on that if they just paid according to the schedule, the minimum payments. So that would be $35,000 in interest. Their mortgage debt is $143,000, okay? And then over time, they're going to have to pay, again, because that long drawn out mortgage, they're going to pay $91,000 in interest. So their principal and what they really owe today is $249,000. Their scheduled interest, if they pay everything according to schedule, is $126,000. So their real debt on paper is $376,000. Okay. So what we did is we plugged all their data into our software. Our software spits out a really cool, a game plan, right? So using our Debt Free Life software, and you can see right here on the screen here, we've got the credit cards, we've got, balances, right? The amount due, we've got interest rates, the monthly payment, okay, current payoff date, the new payoff date, and it shows how much time is left, okay, and then the payoff amount, the redirected payment, and the interest saved. So it breaks it all down. So instead of taking 30 years to pay off their mortgage and all of their debt combined, right, they're going to pay off everything in 8 years and 3 months, including their 30-year mortgage, right? So, and it's going to basically, that's the payoff amount, and it's going to save them $54,000 and about 21 and a half years in interest. Okay, so it makes a big difference. So here's a breakdown of it. It also prints out this, again, a really nice report and illustration exactly based on your specific situation. So again, they're going to be 100% debt free in 8 years and 3 months instead of 30 years. Okay, it shows, okay, the total principal, the interest paid, interest saved, and everything broken down. Okay, so really big deal for a lot of people, right? A lot of people are drowning in debt, right? So the U.S. debt is at an all-time high, and this helps, just helps bring that down at such a rapid rate, right? So we'll show you what happens then. So here's a good breakdown. So $54,000 in interest saved, over $3,000 in monthly, outlay that they can put towards savings now, towards retirement. So think about that. How much more? So imagine being debt free, how much more money you can put towards retirement. Well, it even spits out a report and says, hey, taking that extra money in 20 years, they're going to be debt free in 8. And at year 20, they're going to have $540,000 built up into their infinite bank that they can access tax-free for retirement, okay? In 30 years, 1.1 million, and 40 years, 1.8 million, okay? So basically, the whole idea behind this is there's kind of phases to it. So phase 1 is pay off your debt faster. Phase 2 is use it to fund things in your life. If you need a new car, pay for kids' college, start a business, whatever it may be, make an investment. That's phase 2. And then phase 3, it turns into a tax-free retirement account. So it does a lot of things over a lifetime. Okay, so let's break it down again. So, just like I said in the beginning, who is infinite banking for? Again, people that feel like debt is preventing you from saving for retirement. People that don't want to have a mortgage in retirement. People that want to have their own private bank. People that want to pay off their mortgage without refinancing, okay, which is great. A lot of people, if you have credit issues, credit doesn't have anything to do with this, right? The insurance companies do not check people's credit on this, right, which is great. So real estate investors, small business owners, all that. So again, that's some the typical people that utilize this program, right? So it's pretty much for everybody. So here's a couple examples again. So again, this couple here saved, total debt was $579, saved them $70,000 in interest, debt free in 7.8 years instead of 40. This was an actual business owner. She had over $800,000 in debt, saved her $114,000, debt free for her small business there in 3.8 years instead of 12 and a half years. Okay, so those are some more examples. All right, so next step. So you're like, okay, that's great, sounds great. How does this work for me, right? So what we ask you to do, whoever sent you this, one of our agents, get back with them, and they'll go over this program. They'll put all the data in the software. It prints out a nice report. You can see how this really can benefit you and your family, right? So gather your most recent statements, okay? This isn't a one-size-fits-all solution. In order for us to customize a plan specifically for you, we'll need to understand your financial situation. So please provide the following information to the agent that's, like I said, that sent you this video. And again, we'll put it in the software and make sure that you got, you can just see what a report and what it looks like. We do not need any account numbers or private information, okay? So what we need is a list of assets, right? IRAs, 401ks, savings account, annuities. So just make a list of everything. Where is your retirement assets today, right? Number two, your debts, obviously. Mortgage, okay? So we only need the principal and interest. That's really important. So make sure you back out taxes, okay? Property taxes and insurance, right? So we just need payment, principal and interest only, whatever that is per month. Credit cards, auto loans, student loans, any type of debt that you have, just do a little spreadsheet, on an Excel spreadsheet or Google spreadsheet to get that over to the agent. And we need to know a few things. We need to know the current balance on each of the debts, your current interest rate, your minimum payment, and your actual payment. Okay, so meaning that, again, if your minimum payment on a credit card is $45, but you're paying $100 every month towards that credit card, that's what we mean by actual payment. Okay, and then also if some of your credit cards have some introductory or special rates, okay, something like that, please make note of that as well. Sometimes 0% interest for a certain amount of time. It even figures all that out as well. And then your annual income combined between the family, you and your spouse. Okay, so that's the data we need so we can put that into the system and really customize a plan for you. So that's really the infinite banking concept. Again, we have proprietary software that really makes this a real life vehicle for you, meaning that you can really utilize this and make it simple. We have an entire team that helps you pay off the debts at certain times to stay on top of it. So I just want to say thank you for your time. If this is an interest to you, please get back to the agent or myself, and we'd be glad to show you this and any of our other financial solutions that might be good for you. Have a great day.